Thank you, everyone. We heard catalytic capital being alluded to in the previous conversation. This session's exclusively focused on catalytic capital. Catalytic capital is capital that has the ability to take disproportionate risks, accept concessional returns, and is a great influencer and mobilizer of private sector capital. And I'm very fortunate to have a really esteemed panel with us. They come with different perspectives, and rather than me taking more of time, I want each of them to start sharing their journey, what brought them into the space, and what's next on the cards for them. So if we could start with you, Gayatri.
Thanks, Komal, and thanks, everyone. It's a pleasure to be here. So today I represent the social finance team at UBS Optimus Foundation. And for those of you who might not be aware, so UBS Optimus Foundation is an independent foundation closely aligned to UBS, which is the largest global wealth manager in the world. And we focus on innovating, pioneering ways to solve for social and environmental problems. And sort of we do this through, I would say, three approaches. So the first is impact ventures, which is using grants or social investment capital to support social programs as well as investments into early stage businesses. The second is working more through what we call getting investment in the form of government capital or blended finance or funder collectives. And the third is working on impact transparency. So how do you get a more standardized outcomes and metrics into the space? So that's about Optimus. We focus on healthcare, education, and more recently on environment. And as of date, we've focused on more than 300 programs, invested around $350 million in assets under management. So that's a bit of Optimus, and really excited to speak on the panel and sort of look at the potential of blended finance in India and more broadly South Asia today. Thank you, Komal.
Thank you. Over to you, Richard.
Thank you. I think you've heard enough from me today already, so I'll be to the point. Specifically on social finance, I've been involved for a number of years in a number of different structures and initiatives. So maybe 25 years ago, I was involved in a scheme that was attracting interest-free loans from high net worth individuals to invest in income generation activities and then returning the loans without the interest. So using that capital to pump prime income generation activities. In my last job before I came to the British Asian Trust, I was chief exec of one of the largest not-for-profit organisations in the UK. And we were really involved right in the early days in the UK when organisations like Social Finance and Big Society Capital started. Scope, the organisation that I was chief exec of, we actually launched a social investment bond. And unlike social impact bonds, social investment bonds are actually bonds. And so this was a listed bond on the Luxembourg Stock Exchange. And again, the aim of that was to raise capital to invest in income generation activities. And then at the British Asian Trust, as I think we have been really trying to drive forward an agenda of embracing different ways of working, looking at bringing different forms of capital into the system, predominantly using development impact bonds, but increasingly looking at other tools as well.
Vineet, you're a pioneer in the impact investing space. You have 1.2 billion, as I understand it, under management. You've also been an advisor to the Social Stock Exchange. So it would be interesting to hear, again, your journey and also what's next.
Well, I think I've narrated my journey too many times, so I'll just be very brief. I founded Avishkar. Today we are structured as a holding company with 5 different institutions. Avishkar Capital, which manages close to $600 million or roughly 4,500 odd crores in assets. Then Arohan, which is the largest, around 5,000 crores, 2.2 million women borrowers. We pride ourselves to being a true financial inclusion and not just a cash logistics company, so microfinance from that perspective. Ashwa, which is around 1,000 crores, again, a tech-driven MSME lenders, collateral-free loans of around 10 lakhs, roughly translated into $10,000 odd dollars, $12,000. And then Intellicap, which is advisory consulting company. Finally, the latest is Avishkar Foundation. I have always believed that I would never actually move into, so I used to run probably India's first incubator, which is a not-for-profit. And I then made a choice when I started Avishkar, I will never do not-for-profit. But during COVID, I made a switch because I realized for-profit did not work when you shut down everything. So we launched Avishkar Foundation, and I'm personally quite deeply involved. The idea is to replicate all our learnings that we have done in India, Southeast Asia, and East Africa, and take it to Eastern UP and try to create a deep impact ecosystem for entrepreneurs and see if we can influence significantly just the Eastern Uttar Pradesh through participation of high-risk, impactful capital. Impact investing has walked away from impact quite some time back. We are continuously trying to hold it. So from the investing perspective, we are pretty much investors now. Impact is, for us, investing is what our LPs seek. The foundation might try to do more impact, less investing.
Ramraj, you come with a lens of an ecosystem builder, much like ourselves. You have a number of members in this space. What are the developments you've seen? And again, explain to us your journey and what's next on the cards for IIC as well.
Yeah. Thank you. Yeah, so I'm Ramraj. I essentially head up the India Impact Investors Council. So we are a not-for-profit industry body focused around building the ecosystem for social impact investing in India. I've been here close to now 4 years, and my past background is mostly in financial markets and structured credit ratings and so on and so forth. I think on the key role that the IIC plays is really how do you bring more capital to the social impact sector, and within that I think one of the areas that we are trying to focus on is really this whole space of blended finance, primarily because of one of the reasons that Vineet also mentioned, is that increasingly, if you look at the combination of risk, return, and impact, and if you look at any transaction from these three dimensions, optimizing all of these three becomes very, very difficult. So sometimes the things that create the most high impact could also have a degree of risk which is quite substantial. And therefore, trying to do that with commercial funding has its limitations. That is where transactions like blended finance can help, because we can blend different forms of capital which can enable us to optimize this a lot more for impact rather than for returns, right? That is how this idea of the India Blended Finance Collaborative was begun. So that's a sort of an initiative that IIC has begun with the kind support of USAID. So the whole idea of the IBFC, or the India Blended Finance Collaborative, is to support blended finance transactions in India, support an ecosystem for blended finance in the country, encourage philanthropists, encourage foundations, encourage other people to sort of think or to shift their paradigm from how much impact their money is creating to the paradigm of how much impact are they creating per rupee. Grant funding is the most extreme risk-embracing capital that you can ever find. So the question is, can you make your grants go further? Can you use your grants in some form, directly or indirectly as leverage, which can attract or crowd in more commercial forms of capital? At a very crude level, that is the way we are looking at blended finance. So we are doing a fair bit of work in terms of capacity building, creating exposure for family offices, CSRs, foundations, and other people, in terms of thinking more innovatively, or at least making some small allocation to innovation-driven transactions, where you are trying to create new models of development, very much like what Vineet kind of spoke about. All the three people here are members of the IIC. Vineet and Avishkar obviously have been one of the founding members, but we work closely with both UBS, BAT, and others in trying to support this whole space. And there is always this question about blended finance, and I'm sorry, I'm just exceeding my brief, in terms of the fact that if you are going to mix up, say, commercial financing and grant funding or something to give loans, So, is the cost not going to be high? Are you still not giving, effectively, are you not supporting the commercial guy to make loans? Is something that is always a question. And what people don't realize is sometimes access to something, access to finance sometimes is far more critical than the immediate cost at which that finance is made available. Microfinance is one classic example where over a period of time costs have come down, but still relative to say 6 or 7% at which finance is available, costs can still be higher. But the reality is sometimes access to markets is as important, if not more important, in the initial phases compared to the cost at which financing is available. And that's a paradigm shift that we try to drive, because most people feel, okay, I'm supporting this transaction, so my beneficiary should get it at no cost. It doesn't work like that. Sometimes if you get commercial financing, there's going to be a cost. I'm sure we're going to discuss some of these things in the panel. But broadly, that's the role of IIC and the IBFC, is to try and pioneer newer models of financing, particularly those which bring the equation back to the deeper impact kind of thing. But we can't create the deeper impact always with pure play commercial capital. We may have to think about newer models of finance.
Gayatri, very valid points Ramraj has made around crowding in other kinds of capital. You have done this well at UBS. You've been doing it for a number of years. How do you ensure that you are able to leverage the entire UBS platform to do so? And what is the growth that you're seeing in the blended finance space as well?
Thanks, Komal. I think, yeah, a lot of what Ramraj has spoken, I think we strongly resonate with that. I think given UBS Optimus Foundation sits next to UBS, where we have access to a lot of commercial capital from clients, from institutional investors, I think the blended finance, it's a unique position for us, because we can use this extremely scarce philanthropic capital to actually de-risk and crowd in some of that commercial capital. And I think what we've been doing over the last decade or so, in partnership with BAT, MSDF, and the likes, is sort of creating that proof of concept that there can be these innovative structures that utilize this grant capital much more efficiently, and sort of looking at it as a price per outcome point of view. So I think that's what we've been doing on the outcomes-based side. And going forward, we do see a lot of potential on blended finance, and sort of how do you use that grant capital to crowd in more commercial capital. And probably one of the examples that I could share is that we've also looked at where we have now a $100 million fund which is managed by a third-party manager, and the idea there is to pool multiple DIP structures and get that standardization across the sector and help the sector grow. So I think that's what we are seeing. We're seeing a lot of movement into larger structures, more collaboration, using this capital much more efficiently, so that we can get much more capital into the ecosystem to achieve those SDGs. Yeah.
Richard, you've been a pioneer in the outcomes funding space. You chose education and skilling as a sector, but are there other sectors that lend themselves to outcomes-based funding? And also, again, what's on the cards for British Asian Trust?
So I think most people know the real pioneers in this space were Educate Girls, who partnered with SIF and with UBS, and that was the first development impact bond anywhere in the world. And so what we at the British Asian Trust have tried to do is we learned a lot from everything Educate Girls did. We worked in partnership with UBS to sort of think, what are the learnings from that in terms of how can you scale up some of the interventions? How can you make things more cost effective? How can you bring about that sort of genuine impact? I think that, and again, I said this earlier, one of the main reasons that we're in this space is not just about bringing new capital into the system, it's about making the current system more effective, and really looking at how you can change, make a stronger focus on outcomes and impact, how you can de-risk donor funding, as well as bringing in new money. The areas that lend themselves more effectively to outcomes-based structures are areas where you can identify measurable outcomes. And so education, jobs, healthcare, they're far more naturally lending themselves to these kinds of initiatives. However, we shouldn't only be focusing on those. What we should actually be doing as well is thinking in other areas, how do we identify outcomes? How do we identify and determine exactly what we're trying to achieve? And I think the development sector overall isn't great at doing that. If you want to achieve genuine scale, it's closer to align with what governments are doing, and governments are more likely to be working in the places like education, healthcare, and so on. And so to achieve that genuine scale, those are the kinds of sectors that we need to be in. I think there are challenges. There are some thematic areas that really don't lend themselves to these kinds of structures. So, for example, if we're trying to drive attitudinal change, driving attitudinal change is something that the development sector should absolutely be about, but that's very difficult to identify measurable outcomes in. However, there are definitely other areas like climate change, conservation, mental health, and so on, where we should be better as a sector at determining what the outcomes are that we're trying to achieve.
Thank you, Richard. Vineet, you've acted as an advisor to the Social Stock Exchange. This has been a new development in South Asia, in India. We hope to see greater success on it. Could this be an opportunity to leverage additional capital towards blended products, towards innovative types of financing structures?
So, most people probably in this room are aware about the social stock exchange, but there are still a lot of myths about it. So India is not a pioneer in social stock exchange. There are many social stock exchanges that existed. But as a concept and the way it has actually been put forth, probably it's unique and different from what has happened in the world. It is a government initiative. It's not a private initiative. It is actually being legislated by Securities and Exchange Board of India, which is quite unique because this is now has blessing of both the regulator and the government. This is not about a new technology to trade a bond, which was one of the challenges when we started off, because a lot of people thought that we are trying to encourage a new social stock exchange technology. So India has decided to use whatever, and it has really wonderful high quality stock exchanges that operate, and within those stock exchanges, there will be a social stock exchange that would actually be largely focused. And again, I'll be very careful. While there is no distinction as far as SEBI is concerned between for-profit and not-for-profit, and social stock exchange is supposed to address both. But primarily the evolution has taken place on the not-for-profit side. And that is where we probably are pioneers in the world. The idea at the social stock exchange here is there a way that you can invite not-for-profits to register? Now, registration is effectively, you'll have to make disclosures about who you are, what kind of boards, etc. And then probably raise a bond. The security that we have identified, and this is actually another innovation that probably we have done in India, is we have got a security called zero coupon, zero principal bond. This actually is an innovation, and this has been now identified as a security and therefore can be legislated or regulated by SEBI. In combination with social venture fund, which as a concept already exists within SEBI. So this is a combination activity and not just in isolation. So social stock exchange, a not-for-profit, can identify an activity that it would like to list to raise capital from people. And I was actually trying to find out what is the smallest amount. Generally, SEBI does not regulate anything which is very small, or unless it's actually fully listed. We have tried to reduce the quantum that a retail investor can participate. And since it is zero principal and zero coupon, effectively it is a grant. But a grant which is actually devolves as you deliver the social return, against which there are provisions to measurement, etc. The social venture fund, again, probably is an innovation where India can take great pride on. It is the only vehicle that we have in India where you can receive equity, debt, and grant, and you can actually give equity, debt, and grant. It is not a vehicle that is very well known or very popular, has been utilized. My personal view, and this is what I have communicated to SEBI, is this vehicle is a great vehicle for those who want to do multiple activities using a single vehicle. So people who have family offices should consider having a social venture fund. One of the things that used to worry people to use social venture fund was there was a word called muted in their returns, which I have got it deleted. So that word muted is not there anymore. So if you are not fearful of it, so today you can be a social venture fund and you are nobody is going to question you in case you generate higher returns. From a vehicle perspective, it is a very convenient vehicle because it's the same vehicle that you can do equity, debt, and grant, and you can provide equity, debt, and grant to the vehicle as well. So legislatively, extremely powerful. Also, this is a vehicle where you can raise money from anywhere in the globe. So social venture fund actually has far more openness both in receiving as well as giving. The impact, the zero principal, zero coupon bond has limitations. At this point of time, you do not get the ATG benefits in case you participate in it. At this point of time, foreign capital is not allowed to be participating in it. So there is actually a gray area. Well, not gray area, it's actually black and white right now. We are trying to see if we can get it opened up. But the government has actually been, government wants to see what kind of participation, transparency, and structures we can bring to the table. So a lot has been left for us to do, to participate and then see. I'm on the permanent committee to help SEBI to launch this product, and we are hoping over the next 5 to 6 months, some products will get launched. If we are able to manage it and we are able to convince the government to both open the foreign participation as well as allow ATG and other benefits to flow through, I think this would create a significant milestone potential for the not-for-profit sector to actually raise capital.
Thank you, Vineet. And you mentioned, again, India leading the charge on some of the innovative structures in place. Could the social venture fund be an opportunity to, again, raise catalytic capital that can go into outcomes-based funding, that can go into blended finance structures? Is that possible, Vineet?
So social venture fund actually is a perfect opportunity to do whatever you want. You can give grant, you can do catalyst, you can actually do equity, you can do guarantee. I mean, it's a fairly flexible structure. That government has thought about it in 2014 or 13, and that the structure has existed, but nobody has actually spent much time trying to understand it. Is bewildering. I had a lot of money personally, I would have probably used this structure. But this is more suited towards very flexible capital and not suited toward regimented capital. So when I say regimented capital, if I have an LP and they expect an 18% IRR, then putting a social venture fund will put me through moral issues. So therefore, I'll go for a category 2 fund or a category 1 fund. But if you go for a social venture fund and you have reasonable flexibility to the return that you want to generate, you can use that capital to actually be first loss, which can generate significant returns. You can actually give it as a grant, or you can actually put it as the last tranche with lower returns. But so you can actually play with the risk continuum. And should give you massive flexibility in terms of using it. But the capital, the provider of capital has to make that choice. The structure is available.
Ramraj, we had spoken earlier and you had mentioned that sometimes blending in itself presents challenges. There could be regulatory issues, there could be tax issues. What are the challenges you've observed, and how are these being addressed by some of your members who are putting together these blended finance structures?
Yeah, so I think maybe before I start there, I think it will be useful for us to just make a mention that payment for outcomes is one subset of the larger blended finance space. There are multiple ways in which you can kind of blend. So you could have concessional guarantees, you could have senior subordinate structures, you can have equity funds or social venture funds which have senior subordinate. So there are a whole host of ways in which you can cross-subsidize development through blended finance. So I think it's important that while I think outcomes finance is one way of doing something, there are many, many other ways in which you can do, and many of which have actually been done in India. It is just that blended finance is a new terminology which has been used, but right, I would say, in many, many ways, this has been done for, I would say, the last at least 30, 40 years that, we have sort of been in the markets. So, I think there are multiple challenges. CSR has its own set of challenges because sometimes, when you're financing some of this, the payments which will come from the CSR could go beyond the same year. It could go into the next year. Yes, there have been some regulation which has allowed for it. It's possible that if you are financing a structure and a payment has to be made on a certain outcome, what happens if that outcome doesn't happen? And if I'm a CSR professional, then I have to invest, say, $5 million and figure out that only 4 was invested and 1 was, I could not invest. Then from a Companies Act perspective, I have to make a disclosure. And sometimes that outcome, whether it is happening or not, gets ascertained much later in the transaction. There are some of these kind of practical issues which exist. The government has tried to address some of this. Some of the CSR regulations have also been amended. But I would feel that in general, one of the challenges has been the fact that many of the organizations possibly are not as much familiar with this particular space. So there is a huge need for us to create that exposure, create that capacity, enable people to understand. And let's face it, the regulatory environment for this is not as clear-cut as one would like. The traditional model has always been philanthropy is for people who need the money, and there is commercial funding for people who can pay the money, right? What you're trying to do is something in the middle. You're trying to say that there's a bunch of people maybe in the middle where there is a possibility that they may need some support on the downside, but on the upside, possibly a lot of them could pay. Now, this is a very large segment in this country. What we would loosely call, if I have to say people who are earning between, say, 7,000-8,000 rupees to say people who are earning 20,000 rupees on a monthly basis is a very large segment. They may need some support on the down, but they may be able to also make viable payments. Now, any kind of structure that we are doing is trying to do something in the space which is in this zone. Now, the reality is that the regulatory environment is not very clear, very clean cut, and it is not really designed for these kind of, if I may say, hybrid structures. And in general, such hybrid structures are, if I may loosely put it, seen with a bit of, not suspicion, but there is a sense that somewhere somebody is trying to profiteer out of a narrative which is supposedly development oriented. But the reality is that there is not just people who are poor who just need everything. There is a large segment of very, very low income customers who may need different forms of support, when many of them could catalyze into commercial funding opportunities over a period. That is the segment where blended finance has the greatest use. People have been trying a lot of things, but right now, the way things are being done is because of some of the challenges that people are seeing in blending in India. Effectively, a lot of the blending is done sometimes offshore. So people do the blending offshore and bring it in as a more traditional capital market instrument or whatever into the country. There have been structures where people have been blending in India also. But there are a lot of people who are far more comfortable doing the blending offshore. There are issues with FCRA regulations, and one of the biggest challenges is that if you're going to support some of this, does this need FCRA approval, not need FCRA? Some of those are ambiguities which are there. But definitely blending offshore is something that many people do undertake directly or indirectly. And therefore, the returns or the what is getting returned gets decided in a vehicle which is not onshore, because that is not something which is very legally friendly in the Indian context. So different people have been doing different things. Multiple CSR people have participated. But when you try to bring in foreign investors, these are some of the challenges that have been there.
Thank you, Ramraj. Richard, again, challenges on your side. How do we scale these products? I mean, there's obviously a lot of opportunity there. We're talking about just for APAC alone, it's a 1.5 trillion annual gap. There's obviously where there's a gap, there's a challenge, there's funding needed, there's opportunities there. How do we make sure we get the scale? They're still seen somewhat as nascent, very esoteric products. People don't understand. How do we get to, that education piece done?
Okay, so there's a number of things I would say. I think, first of all, there's a misunderstanding, I think, from a lot of people across the development sector that development impact bonds are ways of raising money. And they think, oh, I'll get involved. It's almost like, we've done philanthropy, we've gone for corporate funding, let's get involved in a development impact bond. It's not. These are structures that are about trying to deliver results. And you've still got to raise the money if you're involved in this area of work. And so people need to understand that this is about trying to change the way that people are doing things. Anything that's about change is going to be difficult. And I think the main obstacles, the main challenges, we've got to, the big one for me is we've got to try and undo 50 years of colonialistic approaches to development. There are organizations across the world, local partner organizations, who behave the way they do because people that had power and money in the global north were forcing them to behave in those kinds of ways. And so a lot of local partner organizations around the world are more geared up to deliver activities that are paid for by some rich donor and trying to build the confidence of the local sector so that people feel empowered to tell global donors where to go if they're funding things they don't want to do is really, really important. And unfortunately, I think a lot of local organizations, because of the appalling ways that global philanthropy and funding has worked in the past, have forced people to a way where they're not able to work in this kind of way that delivers those sort of outcomes. I think the other area, I'd say there's three areas. One is that. The other is getting funders to think and work differently. A lot of funders are just not set up to fund results. So a lot of the big funders in the development space, they like to fund activities. They like to give their money in advance and get regular reports on how that money is being spent. And shifting that mentality so that people are more focused on funding results, and with a DIB structure, that might be their funding is at the end of the process. Changing that mentality is incredibly important as well. And I think the third area is probably for those of us that are involved in the sector. It can sound very complex, and there is, when you're putting together a multi-stakeholder partnership that's cross-sectoral, there is a degree of complexity there, but we overcomplicate it. And I think we need to look at those of us that are involved in these areas of work. We need to look at how do we simplify these structures to sort of democratize them a little bit more and make them more possible for more people to get engaged and involved in them.
Gayatri, again, the same question. How do we get more people involved? You have a private client base, which are ultra-high net worth individuals, foundations, and so on. Again, UBS Optimus has been doing outcomes-based funding for a very small segment of that. How do we make sure we socialize it amongst the larger cohort of your clients such that we get greater adoption amongst them?
Thanks, Komal. I think, echo with a lot of what Richard said. I think for us, we've been doing outcomes-based funding, and again, it is, working with the larger ecosystem on doing a lot of education and advocacy of, shifting that narrative from paying for inputs to paying for results. And I think a lot of the work that we're doing with the Impact Bond Working Group in the UK is to do that, is to sort of socialize that approach with larger, foundations, investors, even governments, and trying to, work with them and also doing a bit of capacity building on, how do you sort of approach these structures. So I think that's sort of one piece. I think on the client side, again, the whole idea for us of sort of adopting these outcomes-based, funding initiatives was to create that proof of concept, because we sit at the cusp of where our philanthropic capital that is given by clients can actually be channelized into paying for outcomes and creating that proof of concept. So I think that's sort of what we are trying to do. And As we speak, we are also now trying to link this outcomes-based funding into the larger narrative of, say, blended finance. So, for example, what we are doing is sort of either using more innovative instruments or concessionary capital like impact loans in early stage projects where we know there is a potential for blended finance to sort of de-risk that and come in early so that they can create those models. So an example is our investment in Fair Ventures, where we've done that in Indonesia on the environment side. And the second is we're also supporting, providing technical assistance to, say, different consultants who are trying to work on identifying models that are investable. And again, this I think alludes to I think our focus on the environment side. That's another sector that we are seeing upcoming, where there is still work that needs to be done on measuring outcomes and sort of doing that in a more transparent manner. But the idea there is it is an upcoming sector. It is the need of the hour. And how do you use this grant capital or outcomes-based funding to identify more investable models for blended finance? So I think that's what we are doing. So it is trying to sort of channelize this outcomes-based approach, not only within foundations, but also within more commercial investors.
Yeah, the more adoption we see amongst the ultra-high net worth, the more we're able to mobilize that private sector capital, whether it's coming from their philanthropy dollar or whether it's coming from their family businesses or whatever the case may be. Vineet, one of the statements you made was impact investing has become more about investing than impact. And that's, again, could blended finance be the way that you bring impact back into impact investing?
Well, totally depends on the quantum of blended finance that's available. I personally don't believe it's very large. So I think I'll actually go back to the whole discussion around social stock exchange and its relevance for those who are from the not-for-profit sector, given that AVPN actually focuses on both venture and philanthropy. I think one of the benefits of social stock exchanges, it is sort of democratizing the capability of a not-for-profit to have control on its own mission. There is a significant amount so it's like in private sector, when we raise capital as an entrepreneur, if I go and raise capital, the incoming investor has far too many asks. And when you go for a listed entity, all the rights fall away. I think the social stock exchange actually allows two things. One, because you are going to a regulated entity, it forces you to make disclosures and transparently lay down what you are going to give as an outcome. Pretty much like Richard and Gayatri were talking about. But at the same time, it is also not giving any power to those who are participating. So you cannot actually dictate to the entrepreneur, in this case, the founder or the management team of the not-for-profit, of what exactly do you want. So it's actually giving a lot of power back in the hands of the not-for-profits. I think this is actually something that has not really been discussed enough. But here, SEBI will act as a balancer. So I can't make an ask. I'll have to actually look at what you have filed with SEBI and make my judgment whether I want to participate and support you or not. But then you are accountable to what you have said. You are no more accountable to what I want. You are accountable to what you have said. However, if you do not deliver what you are saying, then there is a mechanism to hold you accountable. And that's the difference. Now, this essentially means that a large number of not-for-profit institutions may find it very difficult to get into this because you probably have not seen this level of transparency and accountability. It also requires significant amount of institutional capacity to manage it. But once we are able to go through this process, like it happens in stock markets, as you reach a certain level of maturity, you can take the rights of managing your mission without actually having significant interference by making significant disclosures. And this really is the big incentive that social stock exchange, specifically in the context of India, offers. Now, therefore, making it successful is an equally important challenge and an opportunity for those who are sitting in this room. And therefore, one must consider and look at it. First 5, 6 guys might actually get a very lenient look in from SEBI. So do try to get in as fast as possible. Maybe if you become 6th, you might actually getting held much more accountable because first 5 would be pioneers and therefore might get a little softer treatment.
Thank you, Vineet.
Sales pitch.
We do have a few minutes to ask I can see some hands being raised. So please make your questions crisp and to the point so we can get as many answers as possible from the panelists. So can we go to the gentleman in the red?
Hi, my name is Rahul Shah from Sattva Consulting. So whether it's for a social stock exchange or even otherwise, could you talk about some of the key capacity building requirements for organizations to be ready to receive any forms of innovative finance and even the support that they require once they receive finance? And maybe even if you could distinguish between nonprofits and social enterprises. Thank you.
Perfect. So this is about capacity building and distinguishing between nonprofits as well as social enterprises. Can we take one more question and I'll ask both the questions at the same time so the panelists can address them?
Hi, I'm Shruti and I head Cisco for Startups. I really appreciated the points you made about the social venture fund. My observation is this kind of a catalytic capital infusion is extremely important in terms of rejuvenating the social ventures. But I would like to understand the approach that we are adopting to rejuvenate and enrich the markets, especially for adoption. Because I think the adoption is in a nascent state. And what are we doing from a capital perspective to increase the market's awareness and adoption of such new platforms and solutions that we are offering through these ventures?
Thank you. So should we start with you, Gayatri?
Thanks, Komal. So I think just on the question of capacity building, I think there's definitely a strong element of capacity building that we've seen, with our support to the development impact bonds, and we've been supporters of, 3 of the bonds. And I think, again, I think it's a lot of mindset change that needs to go into, into an outcomes-linked payment and outcomes-linked, activities. And I think so that is one aspect of, working with those organizations on, hand-holding them. And then that needs to also flow within the organization across levels. So I think that's one of the learnings that we've seen is that, the on-the-ground teams have to also be bought into such a structure. I think that's very important. They need to understand, what are the complexities they are working in. And again, it is a time-based, instrument which leads to more efficiency in the sense that it does have that, end line. So I think those are some of the aspects where we've seen a bit of capacity building. And I think on the social enterprise side as well, I think it is, if you are coming in early as early stage equity investor in some of these organizations or even providing impact linked loans, that does require a strong element of capacity building, because it is trying to help those organizations navigate those challenges so that they can become investment ready for more commercial or higher growth capital. So I think that's from my side.
Richard?
Yeah, I'll just add a little bit on the capacity building side. I think that when we did the Quality Education Impact Bond and we started looking at how that was going to be structured, so this was about 5 years ago, and we were trying to build on the work that Educate Girls had did, and we wanted more outcomes funders, we wanted more local service providers. And initially there were more than 100 local organisations that were looked at, and that was soon whittled down to about 10. That between the consortium we thought would have the ability to do it, and it's really interesting that so many organisations were keen to do it, but so few would have had the capacity to deliver. And I think it links to Vineet's point about the social stock exchange. It could be a real game changer for a lot of organisations, but there are a lot of NGOs, local partners that wouldn't necessarily have the understanding about how to maximise that opportunity. We've been doing a big piece of work, and people can talk to me or my colleagues or Anushree, our head of social finance in India, about building the outcomes readiness of the sector here. Because it's really important that organizations have the opportunity to get involved. And it's not just the bigger, more traditional organizations that might have the capacity to do that. So I think there's a responsibility on all of us that are involved to recognize where we need to build that capacity and to really do it. And I go back to what I said before. I think organizations are the way that they are because of the way that the system has worked to date. And I really believe that it's, the bad practice of global development going back over 50 years has led organizations to be in this position, and we've got a responsibility to undo that. Very quickly, we had a brilliant event in September looking at the results of the Quality Education Impact Bond. And there was a great session with the 4 local organizations that have been delivering the work. And all of them said it was just a breath of fresh air to work as part of a structure where they were trusted to do the work. They could adapt, they had the flexibility, they were able to pivot. Schools closed in India for 18 months, but we trusted these organizations to work out the best way of delivering the results. There wasn't some big, rich, international institution telling them what to do. And that's where we've got to get to. And because of the damage that those northern organizations have done, we've got a responsibility to support the capacity now for organizations to benefit from some of these incredible innovations.
That's very valid points, Richard. And Ramraj, as an ecosystem builder, again, you work with organizations that have the ability to give assistance, to help build capacity, to help build markets. What is the role you see them playing? What is the work that they're doing?
Yeah, maybe I'll answer that, but I think maybe I can answer the question that a couple of people raised. So I think, for people who want to come on to the social stock exchange, there are going to be sort of capacity which are going to be needed at multiple levels. The first is basically in terms of becoming eligible to be classified as a social enterprise. So the present regulations have extensive requirements. We may all think we are social enterprises, but SEBI has to agree that we are a social enterprise. So I think there are going to be fairly, if I may say, they're reasonably practical. I think SEBI has taken a fairly practical approach to it. But it is at the same time rigorous. So it's not that we can just go and say, yeah, we are a social enterprise and believe us type of thing. So there are going to be a decent amount of rigor in being classified or becoming eligible to be classified as a social enterprise. So I would say there's going to be some rigor around that. The second is in terms of sort of what I may call as the impact standards for the projects that you have. And, I'm sure Vineet can weigh in on this, but I think the Chartered Accountants sort of association here, the ICAI, is creating fairly, again, rigorous standards in terms of defining outcomes, defining what will be classified as an outcome, and so on and so forth. So I would say these are the 2 big areas where there will be, so one will be disclosures, information, all of that stuff, which also today most, not-for-profits are doing, but this may be of a slightly different dimension and of a slightly different rigor, both in terms of their base classification, as well as second is going to be around for the specific project. I would say these are the 2 things. The Social Stock Exchange envisages the creation of a capacity development fund. That fund will create this capacity in organizations, in not-for-profits, in potentially for-profit social enterprises, whatever it is I think the way to go. From what I have heard, possibly organizations like SIDBI, NABARD and others would support this capacity development fund. And the whole idea is for organizations to get ready for the rigors of this kind of a listing. But I'd only like to say, just redouble on what Vineet was saying, that this is possibly one of the first large-scale institutional arrangements where there is government and regulatory blessing for initiative of this size. And if we need scale in our not-for-profits, if you really look at it, there has to be an aspiration for far greater scale, which is not to say that small localized organizations are not creating impact. But if we have an aspiration to create impact at multiple levels, then we will need our largest not-for-profits to become far larger, far more impactful in terms of absolute, crores of rupees or billions of rupees or whatever. So I would say that's the answer to the first question. I think the second question, which the lady from Cisco was asking, is really how do you kind of create that momentum around these kind of, if I may say, sort of Cisco for startups or incubator accelerator initiatives. As we all know, if you really look at the breakup of CSR and other philanthropic funding, supporting startups, supporting startup accelerators, incubators, and similar kind of initiatives comes kind of towards the bottom in terms of the availability of funding. And I think one of the reasons for that is also just the evolution of the CSR market since 2015 when this entire thing started off. I think the first few years went into just building the blocks of creating the pipes for traditional CSR to go into the regular sectors, WASH, education, financial inclusion. These are the, if I may say, the lower hanging sort of immediate fruits because people had to deliver, they had to allocate this money. They had to ensure that they are covering their disclosures and stuff like that on annual reports. I think in the next phase, there is a need for us to really little bit change the paradigm to thinking about if the organization is giving 2% of its profits to me, this is really, in a way, if I may say, venture capital for development. If we can change the paradigm towards saying 2% CSR is venture capital for development, can we use this for more innovative purposes? Can we use this for alternative spaces in the area of sustainability? I think that's a shift which will happen. It may take a bit of time. But yes, we are increasingly seeing many, many organizations coming forward. If you talk to organizations like Will Grow, Social Alpha, and many other accelerator incubators, there is far greater interest today. But I think that's going to be the next phase of shift that will happen from pure play execution of social sector projects into thinking about 2% CSR as venture capital for development. So can I create newer models of delivery? Can I create newer innovations? And that's really the way it's going to go. So that's the sort of answer that I wanted to just give for the two questions.
Thank you, Ramraj. And I note that you have already pointed the way for the kind of innovation that needs to happen. Unfortunately, we are now on time, in fact, exceeded by a couple of minutes. I would like to thank the panelists for their inputs, their insights, and sharing of their experiences. They're still around during the lunch period, so if you have any burning questions, please do approach them and go through it with them over the lunch break. I'm keeping you from your lunch. So with that, thank you very much for listening in.